Most people think real estate investing means being a landlord, dealing with tenants, repairs, and late-night phone calls. Discover how MICs can deliver 8 to 12% yields on pooled mortgages without landlord headaches. Mortgage investment corporations pool investor funds to issue secured, short-term real estate mortgages. You get monthly income while professional managers handle everything else. Canadian regulations require MICs to distribute 100% of taxable income and maintain strict loan-to-value limits for investor protection. Today, I'll break down exactly how this works and who should consider it. I'll compare MICs against the investments you already know to help you decide where they fit in your portfolio. Your bank just offered you a GIC at 3.3% at one of the 5 big banks, and you're wondering if that's your best option for steady income. I understand. GICs feel safe. The bank promises your money back plus interest. No surprises, but let me show you what this actually means for your wallet. Take $50,000 and put it in a typical GIC offering rates in the 3% to 3.95% range that major Canadian banks provide. Let's use 3.5% as an example. After 1 year, you get around $1,750 in interest. That works out to around $145 per month. Now let's compare that to a quality MIC targeting 10% returns. The same $50,000 would generate $5,000 annually. That's about $400 per month. That's double the income from your GIC. Most MICs actually target 8 to 12% returns. Over 5 years, the GIC gives you $11,250 in total interest. The 10% MIC gives you $25,000. That's an extra $13,750 in your pocket. From 2020 to 2025, Canada's inflation averaged 3%. Your 3.5% GIC barely keeps up. After inflation, you're making 0.5% in real terms. That's practically nothing. Meanwhile, MICs can adjust rates on new loans as market conditions change. Since most MIC loans are short-term mortgages lasting 6 to 24 months, they can price new loans at higher rates when interest rates rise. The tax treatment makes this even more interesting. GIC interest gets taxed as regular income at your full marginal rate. MIC distributions also get taxed as interest income, but MICs benefit from their flow-through structure. They don't pay corporate tax, so more money flows directly to you as the investor. Here's where it gets complicated. GICs lock your money but guarantee your principal. You can't touch that $50,000 for the full term without penalties, but you know exactly what you'll get back. MICs offer higher returns but come with market risk. If the MIC operates their fund poorly, you could lose money. There's no government insurance like GICs have. The liquidity situation varies by MIC. Most allow monthly redemptions with 30 to 90 days notice, following standard Canadian practice. Others require longer notice periods. A few have annual redemption periods. This means you might not be able to access your money quickly in an emergency. GICs have the same problem during their term. MICs also charge management fees, usually 1 to 2% annually. This gets deducted from your returns before you see them. That 10% target return might be lower after fees. GICs don't have ongoing fees, but banks make their profit by paying you less than they earn on your money. They might lend your GIC money at 7% while paying you 3%. You just don't see this cost directly. The real question isn't which pays more, it's which fits your risk tolerance and financial situation. Are you saving for retirement in 20 years? The higher MIC returns compound significantly over time. That $50,000 becomes $336,000 at 10% over 20 years. The GIC only grows to around $100K at 3.5%. The difference is massive for long-term wealth building. But maybe you need that money in 2 years for a down payment. The GIC guarantees your principal will be there. The MIC might be worth less if real estate markets struggle, or it might be worth more if the MIC performs well. You're trading certainty for potential. Your age and financial stability matter too. If you're 25 with a stable job, you can handle MIC volatility. If you're 60 and need reliable income, GICs might make more sense despite lower returns. The key is matching the investment to your timeline and risk comfort level. MICs win on income potential. GICs win on security and predictability. Neither is automatically better. Your choice depends on your financial stage, risk tolerance, and what you need the money for. Both have a place in a balanced portfolio. But what about the stock market? That's where most people think real wealth gets built. Everyone talks about stock market millionaires, but nobody mentions the sleepless nights during market crashes. As we all have seen on the news, the TSX can experience significant swings in a single year, with potential annual fluctuations well beyond what most investors expect. Your $50,000 investment value can vary dramatically from year to year. You never know what you'll wake up to. Quality MICs aim for consistent monthly payments regardless of market conditions. They target 8 to 12% annually and pay it out in steady installments. Your $50,000 generates $333 to $500 every month, like clockwork. Whereas stock investors may check their portfolios multiple times per day. They worry about earnings reports, economic news, and market sentiment. Mickey investors get their monthly payment and move on with their lives. The stress levels are completely different. Here's the catch most investors miss about diversification between these two options. They think owning 20 different stocks gives them diversification, but all those stocks have a probability of crashing together during economic downturns. We saw this in 2008 and 2020. The entire market moved in the same direction. MICs give you exposure to real estate debt, which behaves differently than corporate equity. Private credit investments like MICs are less correlated with equity markets during downturns. When stock markets panic, MICs continue lending to underserved borrowers who need financing at higher rates than traditional banks offer. The fundamental difference is what you actually own. When you buy stocks, you own pieces of companies. You're betting on management teams, business models, and competitive advantages. You're exposed to everything from supply chain disruptions to cyber attacks. When you invest in MICs, you own a claim on a bunch of real estate debt. Borrowers put up actual properties as collateral. If they can't pay, the MIC can foreclose and sell the property to recover your capital. Most MICs cap loan-to-value ratios at roughly 75% to protect investors from property value declines. Time commitment tells the whole story. Stock investing requires constant research and monitoring. You need to read quarterly reports, track industry trends, and watch economic indicators. You're making decisions about when to buy and sell. Most people don't have time for this. Some might end up making emotional decisions or following hot tips from friends. MICs have professional fund managers who source and underwrite loans using established criteria. You invest once and collect payments. The income difference is significant. Dividend yields from stocks are typically lower than MICs' 8 to 12% targets. Many growth stocks pay no dividends at all because they reinvest profits. If you need monthly cash flow, MICs win easily. Alternatively, one can do some research on ETFs. Stocks have something MICs don't offer: growth potential. For example, Amazon significantly rose since 2010, as you can see on this chart. Shopify return was crazy, from 2015 to 2022 before crashing. Stocks can double or triple your money if you pick the right ones. MICs focus on steady income over capital gains. Your $50,000 MIC investment might be worth $52,000 after 5 years. Your Amazon stock could be worth $150,000 or $25,000 depending on timing. This creates a clear choice based on your financial goals. Are you 30 years old trying to build wealth for retirement? Stocks offer better long-term growth potential despite the volatility. Are you 50 years old needing current income to supplement your salary? MICs provide steady monthly payments without the stress of market watching. The risk profiles are completely different too. Stock investors face market risk, company risk, and sector risk. MIC investors face credit risk and real estate market risk. If borrowers default and property values drop, you can lose money. But this risk is spread across hundreds of loans secured by real properties. Most successful investors use both. They buy growth stocks for long-term wealth building and MICs for current income and stability. The key is matching each investment to its purpose. Stocks are for growth and long-term wealth building. MICs are for current income and stability. Neither replaces the other. They serve different roles in a complete investment strategy. But how exactly do MICs turn your money into monthly payments? The mechanics are simpler than most people think. MICs pool investor funds to lend, collect interest, and distribute income. You provide capital, they find borrowers, manage loans, and pass through profits. The business model is straightforward, but the regulatory structure makes it work. Let me walk through exactly what happens to your $50,000 from the day you invest until you receive your first payment. Once you've decided on which MIC to invest in and purchase their shares, you will have ownership in the lending pool. Your money sits in the MIC's bank account for a few days while they process your investment. Then it gets added to the pool with money from hundreds of other investors. The pooling process creates the real power of MICs. Your $50,000 combines with money from other investors to create a lending fund worth millions. One MIC might have $100 million in total assets. This lets them make loans that individual investors never could. You couldn't lend $10 million to a property developer on your own, but pooled with other investors, you can participate in these larger deals. The mix spreads your money across dozens or hundreds of different loans. This reduces your risk compared to making one big loan yourself. The lending process targets borrowers who can't get traditional bank loans. Banks want perfect credit scores, stable employment, and lots of documentation. They take months to approve loans. MICs generally lend to house flippers, small developers, and people with complicated financial situations. These borrowers need money fast and will pay higher rates for speed and flexibility. A house flipper might need $300,000 for 6 months to buy and renovate a property. Banks may not touch this deal. MICs specialize in it. MICs often provide loans ranging from 6 to 24 months. This short-term focus means borrowers pay higher rates. Here's how the revenue flows back to you. Borrowers pay 8 to 12% interest on their loans. The MIC keeps 1 to 2% for management fees and operating costs. You get the rest. If the average loan pays 12% and the MIC keeps 2%, you receive 10%. But this gets paid monthly, not annually. Your $50,000 investment generates about $417 per month. This money hits your bank account like clockwork. The Income Tax Act requires Canadian MICs to distribute 100% of their taxable income to shareholders as dividends. They can't keep profits and reinvest them like regular corporations. This law protects investors by ensuring you get all the income the MIC generates. Canadian regulations provide additional protection. MICs must have at least 20 shareholders. No single person can own more than 25% of the company. At least 50% of assets must be residential mortgages. These rules ensure MICs stay diversified and serve retail investors instead of becoming personal lending vehicles for wealthy insiders. But here's what happens when borrowers can't pay back their loans. Real estate markets can crash. Borrowers can lose their jobs or make bad business decisions. Construction projects can fail. When this happens, some MIC stops receiving interest payments on those loans. Your monthly income drops until they resolve the problem. While other MICs may have the cash reserve to continue paying your share while they resolve the problem internally. Therefore, it's important to research which MIC you should invest in prior to committing. The security comes from real property backing every loan. Loans are secured by houses, condos, or commercial buildings. Again, MIC requires loan-to-value ratios of 75% or less. This means they only lend $75 for every $100 of property value. If a borrower defaults, the MIC can foreclose and sell the property to recover your money. The 25% equity cushion helps limit losses when property values decline. The liquidity reality is different from stocks or bonds. You can't sell private MIC shares instantly on an exchange. Most MICs allow monthly redemptions with 30 days notice. Some require 90 days. Others have quarterly or annual redemption windows, particularly private MICs compared to publicly traded ones. You submit a redemption request and wait for the specified period. The MIC pays you the net asset value of your shares when your redemption processes. This redemption system protects the MIC from bank runs. If everyone tried to withdraw money simultaneously, the MIC would have to sell loans at discounts or refuse new loan applications. The redemption periods give them time to manage cash flows and maintain operations. Understanding how MICs work helps you decide if they fit your investment goals. The structure is simple, but the regulatory framework and professional management make the difference between success and failure. MICs aren't better or worse than other investments. They serve a specific purpose in your portfolio for steady income. If you need monthly cash flow without managing properties, MICs make sense. If you want growth potential, stocks work better. Be sure to compare these metrics across different MICs to understand their risk profiles and payout reliability. Based on my understanding, best investors don't put all their money in one place. They use MICs alongside other investments for balance. To learn about how to save money without sacrificing quality of life, be sure to watch this next video here.